4 days ago, on May 5th of 2026, a committee that most Americans have never heard of published a letter to the Secretary of the United States Treasury that contains the most alarming formal institutional assessment of the bond market's condition that this channel has ever analyzed. The committee is the Treasury Borrowing Advisory Committee, known as TBAC, which is composed of the most senior fixed-income executives from the largest financial institutions in the world: Citigroup, JPMorgan Chase, Goldman Sachs, Bank of America, and their peers. These are not outside commentators. They are the primary dealers, the institutions that are legally obligated to bid at every Treasury auction and that have the deepest possible insight into the real-time condition of demand for United States government debt. And what they wrote to Secretary Bessent on May 5th in the formal quarterly letter that accompanies the Treasury's refunding announcement reads not like routine advisory guidance but like a carefully worded alarm. Oil prices are up nearly 60% since the start of the Iran conflict and nearly 80% since the start of 2026. 10-year bond yields in many G10 countries are at or above the highs of the past few years. One-year inflation swaps have jumped by an average of 100 basis points in Europe and 75 basis points in the United States. And this week, beginning Monday, May 11th through Wednesday, May 13th, the Treasury is scheduled to auction $125 billion in new debt, $58 billion in 3-year notes, $42 billion in 10-year notes, and $25 billion in 30-year bonds. All three auctions settle on May 15th, the same day Jerome Powell leaves the Federal Reserve. The same day Kevin Warsh takes the helm. The same day that the most divided FOMC in 34 years transitions to a new chair who is publicly committed to aggressively shrinking the $6.7 trillion Fed balance sheet, which means the Fed will not be buying the bonds that the market must absorb at these auctions. $125 billion in new Treasury debt to be sold to a market that has already experienced weak auctions in March, in the single most consequential week for Federal Reserve leadership in a generation. That is what the Treasury market is quietly preparing for this week. And this video is going to explain precisely why it matters, precisely how it works, and precisely what the historical record tells us happens when Treasury auctions go badly at moments of maximum institutional uncertainty. Let us start with the March auction data, because the Committee for a Responsible Federal Budget published a detailed analysis on March 31st of 2026 documenting exactly what happened when the market last faced a major Treasury auction cycle under stressed conditions: the 2-year, 5-year, and 7-year Treasury note auctions in the last week of March 2026 all went poorly. The 2-year auction was particularly bad, with primary dealers absorbing nearly a quarter of the auction compared to the prior 6-month average of 11%, with a bid-to-cover ratio of 2.44 versus the prior 6-month average of 2.62, and the securities sold at a yield 1.8 basis points higher than when the auction started. That 1.8 basis point tail, as it is called in bond market terminology, means the Treasury had to pay more to borrow than the market's pre-auction pricing suggested was necessary. The primary dealers absorbed more of the auction because the normal buyers, the direct bidders representing end investors, and the indirect bidders, representing foreign central banks and institutional investors, bought less. The upward pressure on yields was driven in part by rising oil prices raising uncertainty about the inflation and monetary policy outlook, combined with investors requiring higher term premium, the extra compensation for the risk of holding longer-term securities in an environment of elevated uncertainty. And crucially, the CRF's analysis concluded, while the recent auction results do not suggest a crisis-level breakdown in Treasury market functioning, they underscore the sensitivity of auction health and federal borrowing costs to economic conditions and shifts in market sentiment. That was March 31st. This is May 10th. In the 6 weeks between those March auctions and this week's $125 billion refunding, oil has risen further to $105 per barrel. The FOMC held its most divided meeting in 34 years with 3 hawkish dissenters opposing even the language of future easing, the TBAC reported. That 1-year inflation swaps have jumped 75 basis points in the United States since the Iran war began, and the Fed chair transition is taking place on the same day these new bonds settle. The conditions that produced weak March auctions have not improved, they have intensified, and the quantity of debt being auctioned this week is not smaller than March's weak auctions. It is $125 billion. The specific importance of the TBAC's May 5th letter to the Secretary of the Treasury is that it provides the most current and most authoritative institutional assessment of Treasury demand conditions available anywhere, because it comes from the primary dealers who actually have to bid at every auction. And what the TBAC said about the current environment is this: rates market sentiment heading into the conflict was that central bank policy rates would be unchanged or lower by end 2026. The increase in inflation expectations since the start of the war has now forced a significant hawkish repricing of central bank policy, most notably in Europe. At the time of print, 10-year bond yields in many G10 countries were at or above the highs of the past few years. 1-year inflation swaps have jumped by an average of 100 basis points in Europe and 75 basis points in the United States. This is not a concern about future risk. It is a description of what has already happened to global rates markets since the Iran war began, written by the institutions that are going to have to absorb the $125 billion in new Treasury debt being auctioned this week. If you are watching this video and understanding for the first time that the Treasury is auctioning $125 billion in new debt this week, that the auctions settle on the same day as the Fed chair transition, that the primary dealer committee formally reported 75 basis points of inflation swap repricing in the United States since the Iran war began, and that March's Treasury auctions already showed weakness requiring elevated primary dealer absorption, subscribe right now, hit the notification bell. Because the historical record of what happens when Treasury auctions exhibit stress signals in the context of Federal Reserve leadership transitions and elevated fiscal uncertainty is the most directly relevant market history available to any investor trying to understand the next 5 trading days. The first historical proof is the Treasury auction stress of April 7th of 2026, which the Brookings Institution's analysis documented in specific detail. The spread of Treasury yields to OIS at longer maturities, a measure of demand for Treasury securities relative to the fixed rate on the interest rate swap, widened sharply on Monday, April 7th, raising concerns that market liquidity for Treasury securities was deteriorating further. The 3-year Treasury note auction on that day was weaker than usual. Investors began questioning whether markets would become dysfunctional as they were in March of 2020. The worst fears eased on April 9th when demand was strong at the 10-year bond auction after Trump announced a 90-day delay in tariffs, but the Treasury yield curve remained steeper than before the tariffs were announced, with 10-year and 30-year yields up approximately 25 to 50 basis points from their pre-tariff levels. The lesson is the specific mechanism. Treasury market liquidity deteriorates when inflation expectations rise, when fiscal uncertainty increases, and when the primary dealer base is required to absorb more supply than end investors will purchase at the pre-auction yield level. All 3 of those conditions are present this week in greater force than in April 7th's episode. Check. Verified. Undeniable. The second historical proof is the 2022 United Kingdom gilt crisis, which Jamie Dimon cited by name in his Oslo bond crisis warning on April 28, and which the TBAC letter's language about G10 bond yields being at or above the highs of the past few years directly references. The UK gilt crisis happened when a fiscal announcement, the Liz Truss mini-budget, convinced the market simultaneously that the fiscal trajectory was unsustainable and that the institution responsible for monetary policy credibility, the Bank of England, would face political pressure in its response. The yields on 30-year gilts surged from 3.5% to over 5% in days. The Bank of England was forced to intervene as emergency buyer of last resort. Pension funds that had used gilts as collateral for liability-driven investment strategies faced cascading margin calls. The crisis lasted days, not months, and it was triggered not by an obvious catastrophe but by the confluence of fiscal expansion, inflation pressure, and institutional uncertainty about the monetary authority's credibility and independence. In the current United States context, the fiscal expansion is the 7% of GDP deficit, requiring $2 trillion in annual Treasury borrowing. The inflation pressure is 3.3% CPI and 75 basis points of inflation swap repricing. The institutional uncertainty is the Fed chair transition happening on the same day the $125 billion in new bonds settle. The structural parallel is not identical, but the mechanism is the same. Check. Verified. Undeniable. The third historical proof is the March 2020 Treasury market dysfunction, which the Brookings Institution's analysis identified as the specific stress template that regulators are still working to prevent from recurring. In March of 2020, the Treasury market, widely considered the world's most liquid financial market, experienced a severe liquidity crisis where even the safest assets in the world could not find buyers at stable prices. Hedge funds that had built leveraged basis trades, which exploit the small yield difference between Treasury futures and cash treasuries, were forced to unwind those positions simultaneously as COVID uncertainty hit markets. The forced selling of cash treasuries to cover the basis trade unwind created a supply-demand imbalance so severe that the Federal Reserve had to intervene with over $4 trillion in asset purchases to restore Treasury market functionality. The Brookings analysis confirmed the Treasury market has changed significantly in the past couple of decades in ways that make market liquidity less resilient to big shocks. The Congressional Research Service's Treasury market analysis published in November of 2025 specifically documented that the basis trade using high leverage could amplify Treasury market stress in crisis situations. Basis trade positions have rebuilt since March 2020. The same hedge fund leverage that created the March 2020 dysfunction is present in the current market. Check. Verified. Undeniable. Now let us apply the full framework of Treasury market vulnerability to the specific events of this week, because the convergence of auction timing, Fed chair transition, and market conditions creates the most precisely identified risk window in the Treasury market since the March 2020 crisis. Monday, May 11th. Is the 3-year Treasury note auction, $58 billion, at 1 in the afternoon Eastern Time? This is the first major Treasury auction after the FOMC meeting, after the TBAC's alarming May 5th letter, and after Iran's weekend escalation that sent oil to $105 per barrel. The 3-year note is particularly sensitive to near-term monetary policy expectations because its maturity overlaps with the period during which the market is pricing the Fed's rate path under Warsh. If the 3 hawkish FOMC dissenters who oppose the easing bias at the April 29th meeting are right that a rate hike is as likely as a cut, the 3-year note's yield must price that possibility. The market's current pricing of near zero probability of a rate hike this year would need to be revised if Monday's auction bid to cover ratio or primary dealer absorption suggests that buyers are demanding higher yields than current levels to absorb the $58 billion. The March 2-year auction's primary dealer absorption of 25% versus the 11% average is the baseline for comparison. If Monday's 3-year auction shows similar or worse primary dealer absorption, it is the first concrete signal of the week's auction stress. Tuesday, May 12th is the 10-year Treasury note auction, $42 billion, at 1 in the afternoon. The 10-year yield is the most important benchmark rate in the global financial system. Every mortgage in America is priced as a spread above the 10-year yield. Every corporate bond's cost is compared to the 10-year yield. Every equity valuation's discount rate uses the 10-year yield as its risk-free foundation. The 10-year yield in the current environment is approximately 4.4 to 4.5%, having risen from approximately 4% at the end of February before the Iran war began. The TBAC's confirmation that oil prices are up nearly 80% since the start of 2026 and that 1-year inflation swaps have jumped 75 basis points means that every buyer of the Tuesday 10-year note is pricing in the probability that those yields go higher, not lower, before the bond matures in 2036. In a higher-for-longer, potentially high-cleaning environment, the 10-year auction's demand will reflect the market's most current assessment of where rates will be over a 10-year horizon that now includes a potentially hawkish Warsh-led Fed, a weak 10-year auction, meaning high primary dealer absorption, a meaningful auction tail, or a low bid-to-cover ratio would be the specific Treasury market signal that bond market professionals would immediately interpret as confirmation that the dim bond crisis warning is beginning to manifest in real-time auction data. Wednesday, May 13th is the 30-year Treasury bond auction, $25 billion, at 1 in the afternoon. The 30-year bond is the most duration-sensitive instrument in the Treasury auction calendar and the one that is most directly affected by Warsh's stated plan to reduce the Federal Reserve's balance sheet, which holds significant quantities of long-duration Treasury securities purchased during the quantitative easing programs of 2020 and 2021. When the Fed is a net seller of long-duration treasuries, as Warsh's balance sheet reduction plan would eventually require, the supply of long-duration paper increases and the yield must rise to attract sufficient private market buyers to absorb both the new issuance and the Fed's disposal. The 30-year auction on Wednesday 13th is the last major market event before the Thursday and Friday settle up, culminating in Friday, May 15th when Powell exits, Warsh takes over, and the full $125 billion in new Treasury debt that was auctioned this week settles simultaneously, the TBACs. Formal advisory report, submitted to the Treasury on May 5th, contains one specific passage about Treasury market demand trends that deserves extended attention. The TBAC commissioned a detailed analysis of structural changes in Treasury demand, presenting data showing that foreign official sector holdings of Treasury securities have been declining as a share of the overall market, that domestic alternatives provide higher yields on a currency-hedged basis for international investors, and that pension funds, a traditional buyer of long-duration securities, have already increased Treasury allocations to reduce their risk profile and represent a smaller segment of the overall pension market than previously. This is the structural demand problem that the Committee for a Responsible Federal Budget, the Brookings Institution, and Dimon's Oslo Warning have each identified from different angles. The traditional buyers of Treasury debt are each becoming less reliable as the quantity of new issuance is becoming larger. Foreign central banks are buying less, pension funds are restructuring toward shorter duration. The Federal Reserve is reducing its balance sheet. The private hedge fund and institutional investor base that must absorb the residual supply is price-sensitive in ways that the traditional buyers were not, and it requires higher yields to absorb supply at times of elevated uncertainty. Here is what the Treasury market's quiet preparation for this week means in specific terms for every investor watching this video. The Treasury market is not crashing today. It is not in crisis this morning. It is conducting its regular auction calendar in a week that has specific and documented stress conditions that make adverse outcomes more likely than in typical auction weeks. The risk is not certainty. It is elevated probability across a $125 billion issuance window. That happens to coincide with the most consequential monetary policy transition in a generation and with the most stressed inflationary environment since the Iran war began. If the 3 auctions this week are absorbed without incident, with strong bid-to-cover ratios, low primary dealer absorption, and minimal auction tails, the bond crisis that Dimon predicted will not have materialized in this specific window. The market will likely rally in relief, and the S&P 500's record high will be supported. by the confirmation that the Treasury market remains functional under current conditions, that is the optimistic scenario, it is possible. If one or more of the three auctions shows the March pattern of elevated primary dealer absorption and meaningful auction tails, the market will immediately price the possibility that subsequent auctions will show worse results, that yields will need to rise further to clear supply, and that the higher yields will exert the valuation compression on equities that the Goldman Sachs bear case scenario models. The 10-year yield at 4.5% in the equity market's discount rate calculation significantly compresses the fair value multiple for growth stocks trading at extreme CAPE ratios. A 10-year yield at 5%, which represents less than 60 basis points of additional rise from current levels, would produce a market impact roughly equivalent to Goldman Sachs's explicitly modeled 5,400 bear case on the S&P 500. The specific investment implication is the same guidance that this channel derived from every other analysis in this current series. Reduce duration exposure in fixed income, maintain liquidity, and understand that the next 5 trading days represent the most specific, most timed, most data-dense convergence of Treasury market risk factors that has assembled since the March 2020 Treasury dysfunction. The TBAC met. They published their warning on May 5th. The auctions are this week. The Fed chair transition happens on the day the bonds settle. Dimon predicted a bond crisis. The die, in his words, may have been cast. This week is the first specific test of whether he is right. Subscribe to this channel, share this video, because the Treasury market does not crash dramatically like a stock market. It moves in yields, slowly, then suddenly. And the week that begins tomorrow, with $58 billion of 3-year notes being auctioned on Monday, is the week in which the slowly is being tested for its proximity to suddenly. The investors who understand that are the ones who have positioned before the test. The investors who learn about it after the auctions are the ones who read about it in the headlines that will describe what happened to the bond market last week. Let me give you the full analytical depth that makes this Treasury market analysis not just timely but structurally unique among everything this channel has produced, because the convergence that this week represents is not just a coincidence of scheduling. It is the specific convergence that every serious bond market analyst has been watching for since the Iran war began, and that the TBAC's May 5th letter has now formally documented as the current operating environment for Treasury auctions. The basis trade vulnerability is the first structural dimension that makes this week specifically dangerous. The Congressional Research Service's formal analysis of Treasury market disruptions, published in November of 2025, documented that basis trades use high leverage and that the rapid unwinding of basis trades by hedge funds could amplify Treasury market stress in crisis situations. A basis trade is a hedge fund strategy that exploits the price difference between Treasury futures contracts and the underlying cash Treasury securities. The trade typically involves buying the cash Treasury, financing it in the repo market at overnight rates, and selling the Treasury future at a slightly higher price, capturing the small yield differential as profit. The trade is leveraged through the repo financing, often at ratios of 20-52, one of the cash position size. When market conditions force simultaneous unwinding of basis trades, as happened in March of 2020, the hedge funds sell cash treasuries to repay the repo financing, which adds to the supply of treasuries in the market at exactly the moment when other sellers are also liquidating, producing a cascading price decline that can overwhelm the dealer network's capacity to absorb supply. The Fed's March 2020 intervention of over $4 trillion in asset purchases was specifically designed to absorb this forced selling. The Congressional Research Service confirmed that a significant portion of Treasury market trading volume is not centrally cleared as of 2025, meaning that the systemic risk from basis trade unwinds remains structurally present, and the standing repo facility that the New York Fed activated at its largest scale in over 2 decades in October of 2025 was specifically designed to provide the repo market backstop that prevents basis trade unwinds from escalating into Treasury market dysfunction. The facility is in place, the risk remains. And this week's $125 billion auction cycle is the specific stress test for the current system's capacity to absorb supply without triggering the basis trade dynamics that would require the facility to be activated at scale. The term premium expansion is the second structural dimension that makes the current Treasury market environment historically unusual. The term premium is the additional yield that investors demand for holding long-term bonds rather than rolling short-term bills. It reflects the uncertainty about future interest rates, inflation, and the government's fiscal trajectory. For a decade of quantitative easing, the term premium was systematically compressed toward zero or negative by the Federal Reserve's purchases of long-duration Treasury securities. The Fed was effectively pricing away the uncertainty that justified the term premium by committing to buy enough Treasuries to prevent yields from rising above its implicitly desired levels. Warsh's stated commitment to balance sheet reduction means the Fed will stop buying and eventually sell long-duration Treasuries. When the buyer of last resort at the margin exits the market, the term premium that was suppressed by its presence begins to normalize toward historically positive values. The TBAC's analysis of structural Trends in Treasury demand confirmed that investors are requiring higher term premium, extra compensation for the risk of holding longer-term securities in an environment of elevated uncertainty as one of the drivers of recent yield increases. The 30-year bond auction on Wednesday is the instrument most sensitive to term premium because it has the longest duration and the most uncertainty about future conditions embedded in its 30-year payoff. A significant term premium expansion at Wednesday's 30-year auction would push long-term yields higher in ways that compress equity valuations most severely for the growth stocks that dominate the S&P 500's market cap weighting. The foreign official sector retreat is the third structural dimension that makes the current auction week vulnerable in ways that prior auction cycles were not. The TBAC's formal charge analysis, presented alongside the May 5th letter, showed that foreign official sector holdings of Treasury securities have been growing at a slower pace than the overall market, meaning foreign central banks are absorbing a smaller share of new issuance. China's Treasury holdings have declined from over $1 trillion at peak to approximately $760 billion. Japan, now the largest foreign holder, faces its own fiscal pressures from the Iran war's commodity shock and is not in a position to aggressively expand its Treasury portfolio. The TBAC's analysis noted that domestic alternatives provide higher yields on a currency-hedged basis for international investors, meaning that the currency hedge costs for foreign investors holding treasuries have increased to the point where the net yield advantage of holding United States government debt is lower than for domestic alternatives. When foreign official buyers step back from Treasury auctions, the domestic private sector must absorb more supply at prices that are set by investors who are more yield-sensitive and less strategically motivated than central banks. The result is higher clearing yields at auction, and higher auction clearing yields mean higher borrowing costs for the United States government, which means the $1 trillion annual interest expense documented in the Rome prediction analysis gets larger faster than the CBO's already alarming projections anticipate. The Warsh balance sheet doctrine's interaction with this week's auctions is the fourth structural dimension that makes May 11th through 13th specifically consequential. Warsh has publicly committed to aggressively shrinking the Fed's $6.7 trillion balance sheet as his primary monetary policy tool, running QT for cuts as the market has come to call the strategy. The Treasury market's absorption of the $125 billion in new debt this week is happening in the context of market participants knowing that Warsh's arrival means the Fed's bond buying capacity will be increasingly constrained rather than available as a backstop, the implicit option value of the Federal Reserve as buyer of last resort, which has supported Treasury market confidence through every stress event since 2008, is being reduced by the stated policy of the incoming chair. When investors price that reduction in option value into Treasury yields, they demand higher yields for the same securities. Higher yields mean weaker auctions, and weaker auctions in the week of the Fed chair transition are the specific outcome that the TBAC's May 5th warning, Dimmon's Oslo speech, and every analysis of the current Treasury market environment has been pointing toward. The specific data that investors should watch across the three auctions this week is the same data that the CRF's analysis of the March week auctions focused on. First, the bid-to-cover ratio. How many dollars of bids were submitted for each dollar of securities offered? The 6-month average for the 2-year note is 2.62. In March, it came in at 2.44. A reading below 2.30 would signal significantly weaker than normal demand. Second, primary dealer absorption, the percentage of each auction taken by the primary dealers who are obligated to bid. The 6-month average for the 2-year note is 11%. In March, it came in at 25%. A reading above 30% at any of this week's auctions would signal that end investors are demanding higher yields than the pre-auction market level and that the dealers are being forced to absorb supply at prices that risk immediate mark-to-market losses. Third, the auction tail, the difference between the high yield at which the auction clears and the pre-auction when issued yield. A meaningful tail of 2 basis points or more means the Treasury had to pay more to borrow than the market expected, which immediately pushes all outstanding Treasury prices lower by the amount of the tail. Each of these 3 metrics will be published on Treasury.gov within minutes of each auction's close. They are public data that any investor can read in real time. And this week, for the first time in this channel's analysis of the current crisis, the data will be arriving in real time from the most consequential auction window since the Iran war began. The Treasury market does not produce dramatic visible crashes of the kind that the stock market's intraday percent moves create. It produces yield increases that translate, through the complex mechanism of discount rates and valuation multiples, into equity market repricing that arrives with a lag of days to weeks after the Treasury signals appear. This is why Jamie Dimon's phrase about a bond crisis, the way it is going now there will be some kind of bond crisis, is specifically alarming. Not because the bond market crashes visibly tomorrow, but because the process through which it arrives, via escalating auction weakness, rising term premiums, higher long-term yields, and eventually, the moment when the Federal Reserve is forced to choose between inflation and financial stability, unfolds through exactly the kind of public data that is available to every investor watching this week's auctions in real time. The investors who understand what that data means can see the crisis forming in the auction tails and bid to cover ratios before it manifests in the stock market prices that most investors will read as the first warning. Subscribe to this channel, share this video, because the Treasury market is the most important financial market in the world, the foundation on which every other asset price is built, and it is conducting its most consequential auction week of the year beginning tomorrow morning at 1 o'clock Eastern Time. The investors who know what to watch will be watching the right numbers. The investors who do not will be reading the headlines about what those numbers produced after the fact. One final element of this analysis closes the loop in the way that makes this week not just financially consequential but historically significant. The $125 billion in Treasury debt being auctioned this week, settling on May 15th of 2026, represents a specific and unique convergence that has no precise historical parallel in the post-World War II era of American fiscal policy. The Fed chair transition on May 15th is the first scheduled transition since the regulatory framework was established that coincides with a major Treasury refunding settlement. It is happening in the context of an oil shock that the TBAC formally described as pushing oil nearly 80% above its start-of-year level. It is happening with 3 of 12 FOMC voters explicitly opposing even the language of potential easing. It is happening with Jamie Dimon on record predicting a bond crisis and saying, "The die may have been cast." It is happening with the TBAC's primary dealer community having formally documented 75 basis points of inflation swap repricing in the United States since the Iran war began. And it is happening with the Congressional Research Service having formally documented that Treasury market liquidity is less resilient to big shocks than at any prior point in the modern era. None of these factors individually guarantees a Treasury market disruption this week. The auctions could go well, the bid-to-cover ratios could be strong, the tails could be minimal, the primary dealer absorption could be normal. In that scenario, the bond market will have passed the most consequential test of the current cycle without incident, and the optimistic view that the market has already priced the Iran war's impact and the Fed transition risk will be validated. That scenario is possible. Its probability is not zero. But the Treasury market's preparation for this week, as documented in the TBAC's May 5th letter, in the March auction weakness data, in the Brookings Institution's analysis of structural liquidity vulnerabilities, in the Congressional Research Service's formal risk assessment, and in every analysis this channel has produced across the entire current crisis, is the preparation of a market operating at the edge of its absorption capacity in an environment that has every documented precondition for the outcome that Dimon described as some kind of bond crisis. The investors who understand that preparation are the ones who watch Monday's 3-year auction result at 1:15 Eastern Time, Tuesday's 10-year result at 1:15 Eastern, and Wednesday's 30-year result at 1:15 Eastern as the specific real-time data that will tell them whether the slowly is becoming suddenly. Subscribe to this channel, share this video. The Treasury market is the foundation. This week it is being tested, and the test results are public, published in real time on Treasury.gov, available to any investor who knows what they mean and where to find them. This channel has now told you both. Use it.